You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. So last week, we actually took some time out to answer some listener questions. Myself and Mark Longo did what we like to call a huddle up. Had a great episode, and we're going to be doing a few more of those in the future because we've gotten such great feedback whenever we do take that time to huddle up and answer listener questions overall. So we don't have a trade to review from last week. A couple of weeks ago, we looked at the XLF going into earnings in the financials overall. And we did have a fairly decent run-up in the financials. The XLF didn't necessarily move a lot, but what has really happened is the big run-up going into earnings has actually kind of turned into buy the rumor, sell the news situation. And a lot of financials did really well in their earnings, but they've seemed to sell off a little bit more so than take off, if you will. So with that said, not much to review. We're just going to jump right into it with another strategy. It is earnings season, and I actually looked through the Option Playbook radio episodes, and I'm trying to look for a strategy that I haven't talked about in a while. And that strategy is called a long calendar spread, or otherwise known as a time spread. Haven't looked at those in quite some time, and normally I don't really talk about time spreads unless they're around earnings season. So this week in the news, we've had a lot of news about Disney, symbol DIS. Disney came out with a new movie this week that did extremely well in the box office, along with its premium services for Disney Plus. That movie was called The Black Widow. So the stock actually popped a little bit just on that news by itself, and it actually broke through a little bit of a resistance level to the upside. So overall, the chart's looking decent in Disney. The news was good as far as The Black Widow is concerned, and they're going to be announcing earnings on the 12th of August. So that's perfect timing to look at a long calendar spread, not because of the earnings, but because of the increase in implied volatility as earnings approach. Now, a lot of times when people think of long calendars, which means I am buying a back month option and then selling a front month option, they're going to both have the same strike. Most of the time when I'm doing calendars, I'm going to flip a coin and pick a direction. In this instance, we're going to be a little bit bullish because of everything that's happened in Disney overall. You can lean bearish if you would like, but then you'd use puts as opposed to calls. Go a little bit out of the money. So we're targeting a range with Disney. And the goal here is that you hope the underlying stock gets to your strike price before earnings. And one of the biggest issues with calendars overall is that you want the back month implied volatility to increase and the front month to decrease. And there's one time or every quarter around earnings, that's usually a known thing that will happen with the option contracts. So a lot of people don't think of long calendar spreads as a long volatility play. But if you think about it in general, if I'm doing a calendar, what do I want to happen to the front month option contract? I want that to go away, right? We want it to go to that strike price. We want the front month option to basically go out worthless, and then we sell the back month option contract, capturing as much time value as you possibly can. So ultimately, on a long calendar spread, you're really just long a call option, right? If you are correct on your forecast and the front month option contract, all the time value is going away, and it's going towards your strike, you're ending up with a long call. That concept means that you are long implied volatility. You want implied volatility on that option contract to increase. And as you approach earnings, what's the one thing that normally happens? Implied volatility usually increases on the option contract that contains earnings. So let's look at the strategy. Here's what we have going on. Right now, we are taping Options Playbook Radio. It is July 14th. The markets are closed. Disney today closed at 183.42. It's down 23 cents on the day. We're going to go out to the August 13th expiration, and I'm going to emphasize it is the 13th. They announce earnings on the 12th. That's why we picked the 13th expiration, which is 30 days away. And we're going to buy the 190 strike call. We're a little bit more than $6.50 out of the money. We are then going to go to the July 30th expiration, which is 16 days away, and we're going to sell the same strike call, the 190 strike call. Now, if we're doing this trade, what we'd really like to happen is the market to go towards 190 before the July 30th expiration, 16 days from now. And by doing this, we're also hoping that the August 13th expiration increases in volatility, and the August 30th expiration basically decays or decreases in implied volatility. So right now, we're actually buying the higher price implied volatility by buying the 190 strike. Vols have not really started creeping up yet, and that's why 30 days out is when I kind of like to look at these trades overall. And Disney just happened to be in the news this week, and it just happened that the earnings are going to be August 12th, and August 13th is 30 days away. So that's the reason why we pick it. And as always here on Options Playbook Radio, we're not looking at these as recommendations. What we're really trying to do is we're trying to take a strategy that's inside the Options Playbook and say, when is it a good time to implement this strategy, giving you as many ideas as possible. And this is the one time or the 4 times of the year that I like to do calendar spreads, and they're all around earnings announcements. And in particular, definitely on individual stocks. Might do it a little bit differently if I'm talking about index options. Gives you a little bit more opportunity in general. But as far as individual stocks are concerned, the one time I like to do any type of calendar or diagonal trade is usually around earnings, where I pretty much know that the back month option contract is going to increase implied volatility, and in the front month contract, we're going to get a good rate of decay and maybe a decrease in implied volatility. Okay, so what's our goal on this trade? Let's go back and do a quick recap of it. Disney right now is trading at 183.42. The markets are closed. We're buying the August 13th expiration 190 strike call, selling the July 30th expiration 190 strike call, doing this for a net debit of $1.91 to the account. We'll call it $1.90 to make the math simple. That means our maximum risk in this trade is going to be $190, or for every 1-by-1 spread, we're going to pay a net debit of $1.90. Now, you got to add commissions onto that, but that would be our max risk, especially if we're going to trade this thing prior to the July 30th expiration. Now, if you go beyond that, and that's very feasible to do, and you end up with the stock or you do something else, there is additional risk that can come into play. But when we initially put on this trade, our total risk is $1.90 or $190 for every one-by-one trade that we do. Now, if I'm doing calendars, you're not looking to get home runs overall. If you ever double your money, you've done really well. Or even make, if I put this on for $1.90, if I could sell it for $2.90, I would consider getting out as soon as possible on that trade. The maximum is going to be reached closer to the front month expiration date. And then also with Disney, if you do got a fairly decent run up, like I said here, we're about 6.5 points out of the money. Not a bad way to look at this trade is to say, okay, the market's gone up. My August 13 option contract has gone up. The August 30th contract is decaying. Maybe I just let that decay and I stay long my 190 strike call that has that expiration date after earnings. In other words, I whittle away at some of that implied volatility premium that I have to pay for earnings. So, for example, the August 13th 190 strike call is trading for $3.15 on the midpoint. We're selling the 190 July 30 strike call, and that's trading for $1.25 approximately on the midpoint overall. So, if I do this trade, I do not want my front month option contract to get in the money. If the market hits that short strike anytime between now and July 30th, I'm going to close out that trade. I might give it 50 cents worth of room, but if it gets more than a point in the money, shame on me, right? Whatever that profit is at that time, I want to get out of that trade. Because if that front month option contract starts getting in the money, as time is decaying, the front month option will go against you faster than the back month option contract. So I want to set an alert for that 190 level in Disney. And if we get to that before that first expiration date, well, then we're going to close out that trade. Now, on the downside, if the market does go down, a lot of times when I put these calendars on, I don't really want to manage that risk. I just say, well, it's gone down. If that front month expires and I'm further out of the money on the back month option contract because the market went down, I might just let it ride into earnings and see what happens. That's kind of my approach. But you can manage your risk in this situation in particular because we're paying a fairly decent amount. We're paying $1.90 for this trade. So I could say to myself, if I lost half of it, if I'm trading for around 95 cents because the market has gone down since we put the trade on, well, then in that instance, I may just close it and just get out. But overall, I usually do not. I put the trade on, let it ride. On the upside, I'm looking to make $1 to $1.50. I may let it ride going into earnings. That's why I like long calendar spreads because I have limited and known risk when I put them on. I like the situation with implied volatility. And I have a lot of different options, a lot of different ways that I can approach this trade. Now, ideally, I usually like to just pick one of them and stick to it. And more often than not, if I put this trade on and the market goes down, I just let it go down. I don't usually get out of the trade on the upside. If it does go up, I will usually close out the trade overall if it ever hits my short strike. But with that said, there's one other option that I can even mention, and I'm probably giving you too much here, but if the stock doesn't quite get to the 190 level, you can even sell one more option contract because there is an August 20th, a July, well, in this instance, let me see exactly what that date would be. It would be 13 minus, so it'd be August 6th. So there's an August 6th expiration date that you could sell if you wanted to, because there's one more expiration before we get to that August 13th date. Bring in even more income if you wanted to overall. So a lot of ways to look at the trade, a little bit more complex because you're dealing with different expirations. But bottom line is when you have earnings, you have a situation where you know the back month is more than likely going to increase in implied volatility. And that's what you want when you're looking at long calendar spreads. All right. Well, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle is @BrianOverby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finished out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.